Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us once again is our good friend and fund manager Dave Kranzler. It's great to have you back, Dave.
Thanks for having me back. It's great to be here. I always love chatting with you guys.
Yeah, and it's been one more of those weeks, Dave. We were just chatting before the show that it's an all too familiar scene really for the whole week, and especially particularly here on Friday with gold and silver being smashed again. And you can really see the algos are in full swing. Really, the overnight trading beginning in the London session and throughout the COMEX Open, and then the smash, which began just minutes prior to 10 a.m. Eastern Time, is pretty much identical from about a $10 lower level in gold and about 15 and 20 cents lower level in silver. But really, it's just identical to Wednesday's trading and the smash we saw on Wednesday. But as we were chatting before the show, thus far they have not been able to get gold really to break down below 1170 or 1150. So what's your take here as the metals are smashed yet again today on Friday, Dave?
I mean, it's just the same wash, rinse, repeat pattern that we've been seeing now for 3 years, and it's been especially prevalent in the last year where the metals, they really rally when Asian and Indian markets are open, and then they start to drift lower or start to get hit as soon as the London paper market opens. And let's make one thing clear here. I mean, historically, London was considered the biggest physical bullion trading market in the world. It's not a physical bullion trading market right now. All it is a conduit for any kind of gold that can be mobilized. It passes through London and into Hong Kong and into China, or through London onto India, and that's it. London is a paper market. It's leveraged at least 100 to 1 in terms of paper versus actual amount of physical that's available, and that includes the GLD vault. And I'm not alone on that assessment. We did an interview recently on our Shadow of Truth project of James Turk, and he agrees with me. And well, really, I should agree with him because he was the original guy to analyze GLD. But he basically thinks that even if there are physical bars sitting in the GLD trust, they have encumbrances on them, whether they're leases or other hypothecation agreements. So London is a paper market, and we see that it's obvious because as soon as the physical trading markets close for the day in the Eastern Hemisphere, they start to sell off gold as soon as London opens. Then obviously once the COMEX opens, it becomes just Wild West, taking pot shots at the price of gold with paper, and that's exactly what we saw last night. I mean, when I went to sleep around 2 a.m. East Coast time last night, gold was up around 1150. When I woke up this morning, it was down about $10. That entire decline happened after Asia went to sleep for the evening. And then right before 10 a.m. East Coast time, gold took an elevator ride that looked like the cord was cut. It went straight down the elevator shaft, another $10. And there was no news triggers. There was no event triggers that would have precipitated that. It was just pure, as you say, algorithmic trading. And that's it. I mean, it's a totally fraudulent price discovery market. So, and it's been that way now. It's almost every day. And it's just getting ridiculous. And what's amazing is they don't even try to hide it anymore. They don't make excuses. They don't try to cover it up. It's just true criminality in our market.
What's your take, Eric, on the trading?
I agree with Dave. I think that this is the same cycle we've seen over and over again. And it's interesting this week. If you compare previous 2 days, you go back to April 22nd, and if you look at like the Kitco chart with the 72-hour layover of each day progressing for 3 days, you can see when the takedown happened today, it matches identically the initial peak and then the running of the stops, the slope of the line, the slight pauses in the decline, and of course, Kitco is not an official real spot generating system, but it nonetheless, as a shadow of the overall markets, does reflect what's going on in the markets in London and COMEX, and so you can see the patterns here, and they're very telling. You can see that an algorithm is behind the execution of this crash, and I'm always amazed that prima facie evidence like this is so visible, where you see exact pattern replication and sometimes even seeing that every single day for like 7-day trading period straight or what have you. I mean, things like that don't happen in normal markets, but people who know enough about markets don't question it if they are aware of it because they just play along with the game. And people that, have no historical reference just don't even avail themselves of this information, or when they see it, they don't recognize it for what it is. And it's a really sad state of affairs that speaks to not only what we all know and see every day with our markets just being ever more a fabrication of the desires of central planners, but also the degradation of the markets extend to human minds of the people that are in these markets. I mean, people don't even recognize this stuff. It's so in their face and so easy to see. So it's just another day, and wash, rinse, and repeat, as Dave said.
Now, it really sets up a potential big move and big week next week with the FOMC, and we've grown accustomed over the last several years to expect big waterfall declines and smashes that begin on the FOMC statement and really typically continue through the following Thursday and bottom at some point on that Thursday. With gold now trading here Friday within maybe $30 or $40 of the lows, what's your thought, Dave? Are we looking at like a waterfall washout bottom possibly next week, or are we setting up another possible short squeeze like we saw in last month's FOMC statement?
That's a good question. I honestly don't know. I wasn't even thinking about the FOMC meeting, and I probably won't think about it until Monday morning. But just to kind of circle back, I wanted to add in a little anecdote here about just evidence about how stupidly manipulated our markets are. So it was Wednesday when the existing home sales number hit the tape, and I just published an article on Seeking Alpha, and you can link on it through my blog. I posted an article on my blog that references the article on Seeking Alpha. The existing home number showed a pretty big jump month over month and year over year. And I go through all the numbers and explain why that was a very misleading report. And the net of it is that the existing home sales weren't what the headlines reported them to be. But at any rate, all of a sudden, the bond market gets killed, the metals get killed, because the computer algos and the market thinking, oh no, the Fed's going to raise interest rates now. But guess what? Shouldn't the stock market have gotten killed also? Historically, whenever they've threatened to raise interest rates, the stock market gets hammered. The stock market started pushing a new all-time high. So the stock market went straight up, and the bond markets and the metals markets went straight down. I mean, it was completely absurd. And that's just how crazily manipulated this market has gotten and how misleading the news is. I mean, it's just completely artificial. So in terms of what's going to happen next week with FOMC, I have no idea. I mean, maybe they're setting up today's hit to try and use the FOMC as the event that they can push gold below 1150 and see how low they can get it, and maybe really scare the piss out of people who own gold, because that's what they're doing right now. They're just trying to scare the shit out of people to get them to sell their metal. And whether it'll work or not, I don't know. On the flip side, they already know, the Fed already knows what they're going to say. They've probably been scripting their press release now for a couple of weeks. So let's say that the statement says they're going to kick the can further down the road in terms of interest rates, which everyone knows. I mean, anyone with two brain cells knows that that's what's going to happen. Maybe a very dovish statement that is issued is the event that causes gold to spike higher. And maybe that's why they pushed it down like this today, so that it has that spike higher from a lower level. I don't know. I mean, these markets are just so crazy, and they're so manipulated by the Fed. There's just no way to anticipate any kind of price discovery or anticipate which direction they're going to move in.
I think the last comment you made about the possibility of prepping in advance for the release because of the fact that they would have to have a more dovish tone is a seriously high probability. I mean, all the economic numbers have been rolling over, and there was some dovishness on balance, more so from the job-owning committee within the last month. We've always gone through this period where the hawks will come out and the doves will come out, and that's part and parcel of this whole manipulation where they're job-owning to set sentiment and expectations anytime it gets out of the range they seek to see, being the net average. It is going to be an interesting week next week with that coming on. And earlier this week, we saw that big crash, smash down on Wednesday after they can get away with not necessarily having to show what's going on under the kimono when they report for the numbers for the commitments of traders. I mean, we frequently see that kind of stuff where the new reporting window begins on end of Tuesday into Wednesday, and they can close naked shorts and change their overall books before the cutoff period on Friday when they're doing data collection, the next Tuesday, and reporting on Friday. So all of this stuff fits with what you'd expect to see people in the manipulation circles, in the bullion bank circles, setting the stage in advance of FOMC. Maybe that's what's going on here. We'll know soon enough. But the bottom line is that the fundamentals for silver and gold keep getting better. I mean, today we had the latest effort to try to resolve the Greek situation in Latvia. There's talks going on, and they were, as expected, a failure. And what did gold do? Well, nothing. I mean, it's irrational. We're cruising down a path that, with each passing month, has elevating odds of Greece pulling out of the Eurozone and defaulting on debt, and their banks being bailed in. And you just have to know that upon, never mind $10 billion of a bail-in in Cyprus, when Greek banks are bailed in the underbelly of the European Union, a whole heck of a lot of people that are sleeping right now when it comes to their understanding what's going on in the EU are going to wake up, and the incremental bid to gold is going to go up a lot. Physical gold, too. So, layer on the geopolitical turmoils that are going on. In particular, add in the scenario that I had spoken about a few times in previous shows, where because it is extremely probable that China is going to be added to the SDR basket, and maybe even 10% gold weighting added to the basket. They are, in fact, talking about that too, China and IMF and think tanks that discuss these possibilities of rejiggering the IMF basket are all talking about maybe even as much as a 10% weighting for gold. But even more importantly, if China is to secure a position in the SDR basket, she needs to come out and declare what gold holdings she chooses to let the gold world and financial world, more broadly speaking, see. And I think that she's going to report sometime in the July frame, plus or minus a month, and come out with a number that's below 4,000, but above what Germany has. China will be targeting the slot of being the second largest gold holder, quote unquote. I mean, even though China might have, as much as 20,000 metric tons for all we know, and I think the best work that speaks to that is what Alistair McLeod has done. But certainly, even back to the napkin calculations I've done, point to well over 10,000. So this is not going to be a declaration of what China owns, but it's going to be a declaration that shocks the heck out of people in the mainstream and conventional finance world, because their understanding of China's yearly demand takedown is completely skewered by the World Gold Council's numbers and GFMS further back in time. So, this is going to be an event that can be foreseen, foretold, and the most probable reaction to it will be stimulation of interest in gold. So all of these things are pointing towards a really good summer for the precious metals, and I'm optimistic that that's what we'll see. And on top of everything else, I mean, manipulations end. They can't go on forever. And this one has been so extreme and so intense and for such a long period of time. I mean, now we are in the stretch that has exceeded any other bear market in gold. It's painful to watch all this stuff, but it's only a blessing in disguise because it allows people to accumulate more at a lower price.
Dave, I also wanted to discuss a little bit here your recent article about the parabolic explosion in in reverse repos, and really it's the first time we've seen that since 2008. So why don't you tell the listeners a little bit about what you've noticed with that?
Actually, the genesis of the article was a friend and a colleague sent the article to me, or sent me the graph from the Fed website, and I have no idea what he was doing, swimming around the reverse repo section of the St. Louis Fed website looking at graphs. I mean, not the first thing I think of doing in the morning is going to see what the Fed's doing with reverse repos. And when he looked at it, he kind of mistakenly interpreted it to mean that the Fed he looked at it in the way that you would interpret a graph of repos. Okay, so the way it works is a repo is when banks need cash overnight or on a very short-term basis, and the Fed puts up cash, and in exchange the banks collateralize. When they take the loan from the Fed of the cash, they collateralize it with treasuries. So it's basically an overnight or a very short-term cash loan collateralized by treasuries. So a reverse repo is just the opposite. What happens is banks need collateral, and they have cash. And so what happens is the banks borrow treasury collateral or mortgage collateral from the Fed, and they put up cash to collateralize the loan. Now, typically, a reverse repo is done to remove liquidity from the banking system, and that's theoretically how the Fed should have been or would have been unwinding their quantitative easing if they could unwind their quantitative easing and not cause the whole system to collapse. But we know they can't do that because the banks still have $2.6 trillion in excess reserves, which is the cash they built up from the Fed buying treasuries from them, and it's sitting in the excess reserve account at the Fed earning interest. So the way that it would unwind the QE would be to reverse repo that cash out, where the Fed would take its large treasury portfolio, give it to the banks, and in return the banks would take cash from their excess reserve account and give it to the Fed. But what's going on here is reverse repos to foreign official and international accounts. So that basically means it's reverse repos to foreign central banks, read ECB banks, and international accounts, read ECB system banks like Deutsche Bank and Barclays and things like that. And when I looked at the graph, I saw that the reverse repos had spiked up an incredible amount, I mean almost straight up, starting in early September 2008. And we know September is when we basically had a de facto collapse of the financial system. It was right as Lehman was collapsing, and it was right as essentially Goldman and AIG basically collapsed. Let's call it for what it is. It was a collapse. And if Henry Paulson wasn't strategically placed in the Treasury Department, Goldman might not be around today. So we had a spike up then, and we've had an even bigger and straighter up spike up that started on December 17th of the end of last year. Now remember, this is essentially an operation in which the foreign banks and central banks are giving cash to the Fed, and the Fed's giving them treasuries as collateral. And the only reason I can think of, because what happened in 08 is what I think is happening now. What happened in 08 is that we had basically had a behind-the-scenes derivatives meltdown. Well, it wasn't behind the scenes with Goldman and AIG. That was an overt, outright derivatives meltdown. But we also had, huge derivatives meltdowns over in Europe, and U.S. banks were massively exposed to that as counterparties. And so I think that basically the same thing has happened this time around. And what's interesting about that is I had sent an email around the mid-December to Bill Murphy of La Metropole Cafe, and I said, I just have a bad feeling that there's something melting down behind the scenes, the way they're manipulating these markets and the way they're trying to smash the price of gold. And his response to me was, it's funny because I just got off the phone with John Embry, and he said the exact same thing to me. And so I'm thinking, well, maybe I'm a little off mark in my thinking here, but if someone like John Embry is thinking the same thing independently, if we're both seeing the same smoke, then there's probably a real fire somewhere. And when I saw this graph of the reversed repos the other day that my buddy sent me, that confirmed my suspicions, because that's the only thing that can be going on. And the way that works is that, and as everyone who's listening to this probably knows, Zero Hedge has been reporting ad infinitum about the shortage of collateral. And one of the collateral, meaning treasury securities that banks put up, they posted as margin collateral against derivatives trade. And one of the pieces of evidence of that is the massive amount of treasury failure to delivers, which Zero Hedge has done a great job documenting over the past year. Everyone's seen that. Everyone knows what I'm talking about, I hope. If not, Google it and you'll see. So what that happens is, the reason why that happens is that when there's a failure to deliver of a treasury, it means that someone is short that treasury, and whoever they borrowed it from is calling on the person who borrowed it to redeliver it, because for whatever reason. You don't have to give a reason when you have a security out on loan and you need it back. You don't have to give a reason. And it's basically, I think with bonds, you have 3 days to get that security back and deliver it to the other guy's back office, or it's considered a failure. And then they extend the delivery period, but you can't extend it by much. So what's happened here is that, in addition to the fact that the Fed has sucked a lot of the treasuries out of the system through QE, which reduces the amount of treasuries that are out there that can be used as collateral. So that means that there's a lot more inter-dealer treasury borrowing. When a dealer needs to put up treasuries as collateral for a derivatives trade or a derivatives position, then they can just go borrow treasuries. But if all of a sudden there's a shortage of treasuries, or if someone starts calling treasuries because they need their treasuries back, and one of the dealers has it out on loan, that's how you get the failure to deliver. That's how you get that's what precipitates the collateral shortage that Zero Hedge references. So, and we've read about it being a huge problem over in Europe. In fact, the ECB has even considered using, allowing banks to put up equities and junk loans as collateral when they have to post collateral for whatever reason. And so when you see a spike up like that, the only thing where those treasuries can come from that are being reverse repoed out into the market is from the Fed's, what is called the SOMA book, which is the book where they've put all the treasuries that they've bought, that the Fed has bought from QE. That's the only source where those treasuries could have come from, is from the Fed's long-term treasury portfolio holdings from QE. And what it tells me is that banks over in Europe were getting margin calls on their derivatives, okay? So when you get a margin call on your derivatives, you got to post more collateral or you got to unwind the trade. And these banks don't have the liquidity to settle the trade, right? You settle it in cash. So typically what they want to do is they want to put up collateral to post margin that they're being called on. Well, if they can't find treasuries out there to post as collateral, and they certainly can't find sovereign paper out there to put up as collateral, and the ECB has just declared that Greek sovereign paper gets a 50% haircut as collateral, so they don't have enough Greek paper to post as collateral. The only source where they can get treasuries to put up as collateral is the Fed, and so that's why you see that huge spike up in reverse repos. And what it means is that there's been a fairly significant amount of derivatives behind the scenes that have been melting down that require the posting of collateral. And what the nature of those derivatives, the two most obvious sources or examples would be credit default swaps tied to Greek sovereign paper. Because if there's 350 billion of Greek sovereign paper outstanding, I can guarantee you there's been credit default derivative transactions in the face amount of 3 to 4 times that amount, which means, you've got over $1 trillion of credit default swaps where one party's betting Greece won't leave the the EU, and the counterparties betting that Greece will leave the EU. So as the risk that Greece leaves the EU becomes greater, the value of the guy betting that they won't leave the EU, his bet goes down in value, and he has to post collateral. So that could be one source, is Greek-related credit default swaps. And the other source, and no one's even talked about this, which blows my mind. In case anyone hasn't noticed, we've had basically a 50% collapse in the price of oil in a very short time frame. And I was talking about this with a friend of mine who's a hedge fund consultant and who was also a banker at Bankers Trust and knows a lot about derivatives. We were talking about this a few months ago about how the fact that we haven't heard anything about energy derivatives blowing up. Well, I can guarantee you that there were trillions in structured OTC derivative notes that allowed people to speculate on the direction of the price of oil. I guarantee it. And so when you have a 50% drop in the price of oil over a very short period, those derivatives are going to blow up. And if they don't, and if you don't want to if you don't want to settle your derivatives trade when you lose on your bet, it means you got to post more collateral. So there could also be some massive oil-related OTC derivatives that have been blowing up, and that could be the reason why the ECB system banks need treasuries to post as collateral against those trades. But either way, whatever the cause is, it tells us that something derivatives related has been melting down behind the scenes, and it's been happening since mid-December.
And it's not a matter of speculation either. I mean, when I first saw that article, I was floored. It was the best article you've written all year, Dave. It's incredibly important because it's a smoking gun. You can see that this collateral shortfall is behind what's going on, and there are only a certain set of conditions where that can happen. And it all points to a low-grade fire burning in the background, or another analogy, like a lit fuse on this derivatives bomb that could blow off. And the central planners of the world are trying to kill it. I mean, a couple other interesting context notes that I noticed when I was reading that was that the December spike up that Dave spoke about corresponds exactly to when the Swiss National Bank was beginning to signal their intentions of depegging, and when Mario Draghi came up on the soapbox and once again said, we're going to do whatever it takes, and we're going to really want to do QE, and please, people in Germany and so forth that have more sound money inclinations go along with the program, and lo and behold, turn of the year, and ECB launches their QE program after having setting the expectations in this exact same period where we can see the central bankers going berserk and trying to address this lift fuse. So all of the pieces of the puzzle fit, and it speaks to what's going on in the background. I mean, there definitely is a derivatives crisis underneath the surface here that we can see the shadows or the footprints of the reactions of the central bankers addressing it or attempting to address it. The other thing, too, that's worth pointing out when it comes to collateral, that 10 years ago, the Federal Reserve could only use treasuries as collateral, and then they changed the rules to include mortgage-backed securities, and over here, just like what they've been talking about in ECB, about liberalizing to the point of even having stocks and whatnot. I mean, the rules of the game have been changing because we have a collateral good problem in our system, and it's a product of failed derivative trades across the board. The 2008 crisis was a symptom of derivative trades going bust, and these manufactured sausage products of the mortgage-backed securities with AAA fake ratings on them, and on and on and on. And it's once again another example of the byproduct of the system that has reached the end game. That's what all of this points to. So we had the crash in 2008. Everybody tried to address the issue but not fix it. And here we are again. We're setting up for another crash.
In that same time period, we saw gold and silver smashed really hard and hit lows, really the same as we saw in 2008 as the banks scrambled for liquidity.
Yep, that's exactly right. I'm glad you brought that up, John, because I was going to. They annihilated the price of gold during the summer of 2008. I mean, I'll never forget it. And gold had hit 1,035 in March, and they started selling it off. And that summer, they took gold down to 700, and they took silver down. I think silver hit 8. And it turned out, and I was like, something really bad's going on in the system. Boom, Lehman collapses, Goldman AIG collapse. They roll out they do the TARP thing. They roll out the QE, and I guarantee you they had all this stuff pre-planned. And that's why they had to hit the price of gold. I mean, they'd rather see gold make a move from 700 and it eventually ran up to 1,900 than make a move from 1,000 and go over 2,000, because then once it goes over 2,000, they're going to completely lose control of it. But it's the same exact thing, and that may be what's going on right now. It may be why they're working overtime to keep a lid on the price of gold, to try and hide the fact that there's things blowing up in the derivatives world behind the system. Because I can guarantee you, if they let the price of gold trade freely, the price of gold would probably shoot up to 3,000 quicker than anyone could possibly realize.
And that kind of fits with the time frame as well, too. If you look at the peak of gold, it was January 22nd, and that is when we saw stepped up reportage about Greek negotiations, because the end of February, I think it was February 28th, they had a big tranche of debt that they had to pay to Troika and all that. So the stress in the system was elevating, and if indeed we're talking about one of the primary problematic assets, credit default swaps on Greek debt being barbecued and declining the balance sheet net worth of banking participants and whatnot that are lunking around in those markets, they would immediately translate into a collateral requirement to increase collateral to offset the garbage derivatives that blew up on them. So all this stuff fits. I mean, it's a very compelling theory as to what's going on behind the scenes, and we will link that article to the write-up that I do for the show. We had it up on Silver Doctors. I put it out throughout Facebook and spread it around as much as possible, because I think it's one of Dave's best works ever.
Oh, well, thank you, Eric.
It isn't always the longest piece that makes the most insight. That was just a very simple article, but no one has covered this, and you deserve kudos for it. I think this is the first time, to my understanding, that this was put together, the pieces of the puzzle, and I think we do have a low-grade fire going on in the derivatives market, and Lord knows when it's going to blow, but it could very well do, just like 2008.
I have to give a hat tip to my friend who sent me the graph, even though he had initially misinterpreted it. As soon as I looked at it, I knew exactly what was going on.
Yeah.
When I pulled up that thing, I was just like, holy crap.
Yeah.
Embry and I were right about something melting down behind the scenes.
We had Bill Murphy on in January, too, and he had said his other side of the same phone call that he had with Embry. So it's kind of funny you bring that up, because he was on the show talking about that same example. Not the derivatives thing that you had discovered, but the questioning of, well, there's got to be something here. What is it? And now we know what it is. Or at least one of the things. I mean, there may be 5 others that we have yet to discover.
No question about it, Eric. No question about it. I've said to several people over the last few years, we all understand that the market's completely manipulated, but I have a feeling if we could peek behind the curtain and see what's really going on, it would be 10 times worse than we know it to be. We'd probably just be completely horrified.
And on that note, we'll look forward to next week's FOMC.
Right. So, Doc, what's going on in the physical market? You got any interesting reports as far as what you see retail-wise with SD Bullion?
Premiums are starting to move a little bit, but we really haven't seen the big movements like we have in previous smash downs, but that could change in a heartbeat if silver goes down much further at all from here. Customers have been calling in, reporting to us that many of the major dealers are sold out in Silver Eagles. We haven't heard anything from the Mint. The Mint sold out, but again, the market is shaken up a bit with one of the authorized dealers, Jefferies Bach, being bought out by the French bank, SocGen, and SocGen shutting down their metals desk. So there goes one of the authorized dealers. So a bit of a market shakeout as allocations and supplies sort out with Jeffries exiting the market. But we really haven't seen a big physical shortage yet. So we'll keep our eye on it. Demand continues to be extraordinarily strong, especially here today at the second half of the week, really, with gold back under 1,200 and silver back under 16. Just exceptionally strong retail demand continues.
Have you noticed anything interesting on the front when it comes to the ratio of first-time buyers to return buyers, and also the ratio between really large individual purchases by people, be they first-time or not, versus just the average order flow? That might give a hint as to somewhat shifting expectations and sentiment in the market.
Sure. Perhaps a bit different from times past, and definitely different from the time period we were talking about above October, November last year. Really, it's been more marginal money in the market right now. We haven't seen the real big buyers and big customers spending $250,000, $500,000 at a time. It's been...
And you did see that in December, right?
Yeah, October, November, December, the big money was in the market in a big way. And we really haven't seen that too much lately. It's been very steady and strong demand, but more your average middle class, average Joe, upper middle class that has anywhere from a couple $100s to a few $1,000s to invest that they're likely saving from their paychecks. So it's definitely a lot more skewed right now towards the average investor who's continuing to accumulate insurance at these excellent prices.
And that fits as well with the pattern of this funk we're in, capped by 1,200 gold, etc. And earlier in this year, going into that January 22nd peak, there were a lot more people in the conventional finance world dogpiling in. We could see that with the 500 million addition to GLD and the footprints of people who were buying more paper. And I have an operating theory too that the cartel has a lot harder of a time to execute manipulation and capping when all of the paper jockeys are pouring in, because it kind of diminishes the paper games that the cartel plays. They take the other side of the trade, so to speak. So that's not going on right now. And I think that at some point the paper jockeys will be stepping into this picture as well too, because it's obvious that there's probably not going to be a solution with Greece, and that's going to be a catalyst that it goes back to what we were just talking about with Dave's article. There's going to be problems, and there's going to be an increase in the incremental demand for gold and silver in turn. So it definitely will be an interesting summer.
Well, before we let you go, Dave, and we wrap up the show, if you can let the listeners know where they can find your regular work and as well as your subscription service.
Sure. The name of my blog is Investment Research Dynamics, and it's investmentresearchdynamics.com. And I have links on there to my research reports. I've got one on Amazon, which has just gone ridiculously parabolic today. And the numbers they reported yesterday were not good. In fact, they burned over $4 billion worth of cash in the first quarter, which was 2/3 of the $6 billion that they raised in the fourth quarter of 2014. And then I also have some research reports on home builder stocks and mining stocks.
All right, so we highly recommend all of Dave's work, and check out his work at investmentresearchdynamics.com. Well, we'll wrap up this week's show here. We'll keep an eye on the markets, particularly on Wednesday of next week with the FOMC statement. So stay tuned for some action that's for sure to come one way or the other next Wednesday. For the Doc and Eric Dubin and Dave Kranzler, thanks for tuning in to this week's SD Weekly Metals and Markets.